Hi, my name is Z. I'm a professional options trader with Optionalitie. For context, I've returned 25 to 50% on my account every year for the last 5 years. Today, we're going to talk about how to short the market top with no risk. Let's begin. So we've been in bull market for a really long time. Picking the market top is extremely hard. And in fact, if you've been doing it, you've probably been getting crushed. This is a chart of SPY. And I mean, look at this. We would just go up, grind up on SPY for months on end, and every pullback, yes, they do happen. They're relatively sharp, so it is a worthwhile endeavor trying to pick the top or shorting the market. However, in general, it's extremely hard, and you have to get very creative, and you have to have asymmetric risk reward. So today, we're going to be talking about my favorite way to get edge and get really good risk reward. And it comes from skew. So I talk about skew in a lot of my videos, but the concept is skew controls options pricing. You can guess, and you can be pretty good at guessing if the market's going to go up and down, but you can't control that. What you can control is how much you get paid out on your position. What is your risk reward? And what drives really good risk reward in your options trading, especially when it comes to spreads, that is skew. So skew is the difference between the implied volatility of out-of-money calls versus the out-of-the-money puts. And a lot of people talk about the implied volatility smile or the skew smile. What this is characterizing is that the implied volatility is the least at the money options, the options that are closest to the strike price, and sometimes, well, most of the time, they will increase as you go more out of the money on the put side. And on the call side, that sometimes happens depending on if you're in a high beta stock, or it'll actually fall as you get more out of the money. And we'll take a look at this right now. So let's go onto the platform. So here is actually, there is a CBOE skew index that is calculated at the end of the day every single day. So it's kind of like a funny looking chart. I put it into a line form, and there's no bars, so you'll just see like one dot per day. And the higher the number, the higher the implied volatility is on the put side as compared to the call side. So we're going to be looking at a trade that I made on QQQ, and this is quite the fantastic trade. We were able to book over $1,000 in profit on this trade. I actually did the same exact thing in SPY as well, one day before. But what I did was I bought a put spread, a 9 or 3 lots of 465, 460 put spread, and I financed it with selling twice as many puts, but at a much, much, much lower strike price. So let's take a look at what was going on that day. So this is to illustrate the skew. Let's take a look at, this is QQQ right now. I mean, it's probably exactly the same way on SPY, but you can look at the money volatility, which is about 21. But as you go farther out of the money on the put side, you see it ramps up, and it ramps up pretty quickly. So it goes from 21% implied volatility all the way to like, almost 40% implied volatility. The numbers get crazy big down here, and that's mostly because the bid ask can only be 1 cent is the lowest amount, and it's a calculation. And when you can only go up and down 1 cent increments, it really screws up what the implied volatility calculation is. But you'll see on the call side, it starts off at 19 and actually drops all the way to 16 before picking back up a little bit. I wouldn't worry about the picking back up. It probably, in theory, would drop even more if you can go sub-cent in pricing. But that is what the skew smile looks like. It's actually on index products. It will, kind of just be like a line down. On other high beta products, the out of the money calls can have more implied volatility than the at the money calls, depending on how much speculation there is in those options. So I put this on August 30th, which is somewhere around here. August 30th right here. So you'll see that like skew spikes, every once in a while. And I have noticed that this is not a great indicator, but it sometimes correlate with market tops. So, that's half of the edge. half the edge is me knowing that, hey, the options market pricing is actually indicating that a lot of people are selling calls, out of the money calls, and buying puts with that premium to hedge out their long portfolio. So no matter where the market is, the options pricing is telling us something that the intrinsic price of the stock is not telling us. So this is a small edge, I would say, but more importantly is how do we leverage skew in the options pricing. So on that day where it really went up, let's take a look at where let's take a look at where QQQ was. So QQQ, and we're going to go back to our bar chart, candlesticks. So the 30th is somewhere around here. So the market is actually making a relatively bullish day right here. So it gapped down here. It actually gapped up and kind of just like stayed, had a pretty good move here. And we're pretty close to the all-time high. So no, we're not calling the top here, but I would say this is a good, counterintuitive place for the market to kind of dump. So I did notice that skew on that day was very high. So what I did was I put on that trade that I was talking about. And to illustrate the implied volatility, we're just going to go think back. We're going to go August 30th, 2024. So here is September 13th, and you'll see that the at the monies are trading for about 18% implied volatility, but the out of the money are trading for 25, 26%, and this is at about a 160 skew. We can just go a couple days back, a couple days back. So it was about 130, 160 here. Just a couple days back, it was around 150. So let's just take a look at what impact skew has on pricing. You'll see that the at the monies are about 20% implied volatility, which is significantly high. That's 10% higher implied volatility than the at the money that we were looking at on August 30th, which is quite a bit. And in addition, as you go farther down, they're right around the same, about 25. But the ramp between 20% to 25% is significantly less than the ramp from 18% to 25%. We're talking about 10% more change in implied volatility that makes your options 10% cheaper, which in my opinion, that's a lot of edge. So we put on the trade on August 30th. We put it on towards the end of the day, and you see that the market did move against us a little. Well, against us, it moved in our direction a little bit. So I was able to fill it at about 50 cents and $100 for 94 cents for the put spread. So I actually had a little bit of credit going into this thing. But yeah. So I paid absolutely nothing for this. So what does that mean? If the market just rockets straight up, I don't lose any money because I didn't pay a cent to get into this position. So let's take a look at what actually happened in the next couple of days. So let's go back to QQQ. So what you want to happen is for the market to either gradually come down, go sideways and come down. You prefer it not to crash, although you can manage yourself out of risk if you do crash, but you generally would prefer it to just kind of go sideways and then go down and kind of nicely, gently drop into your profit zone. Now that's not how Mrs. Market behaves. You know that the market just kind of does exactly what you don't want it to do, and that kind of happened in this case, but not really. So let's talk about the price action. So the next day, the market, this is a 3% down day, so the market went hard against the short strikes, not against the position, but against the short strike. So let's take a look at what happened the day afterwards and the pricing for that. So let's go to September 3rd. And you see that we were down 3% on QQQ, and you see that the 440s actually exploded in value from, it actually didn't go up that much in value. It went from, say, 50 cents, which is what I got in for, to $1.50, which is 3x. But we are like in the money. We are in the money already on our put vertical right here, which is awesome. Right? This is trading for $1.80. So we're actually down on the position because when volatility expands, but we're just getting more intrinsic value, the the out of the money puts will expand a little bit more in value. So you'll see that in order to get out of this position, sorry, this is supposed to be there. There we go. We actually have to pay 80 cents to get out of this position. So it technically is going against us. Now here's the thing, is that there is risk in this trade, but it's extremely easy to manage yourself out of this, out of the risk in this trade. What do I mean? Well, the worst thing that can happen to you is if the market hard dumps in the direction of your short puts. How do we manage that? Very simple. We can sell calls, near dated calls, much farther out of money where your resistance levels are. You can sell money on top, and you can use that little bit of credit to either push your short puts down, or you can put a short put vertical in front of your short puts. So what do you mean? Well, so in this day, say, okay, this is on the end of the day, and I would be doing this much earlier in the day. When you're gapping down over here, you're below the support here. I mean, you need to be not having any positive delta. You need to turn whatever delta you have to a negative delta, because you should not be breaking out of the range on this side if you're positive. So when you break out of a consolidation like this, what you can do is you can sell against the top of the consolidation, and don't sell right at the top of the consolidation, because you'll be taking a lot of heat even if you're right. Maybe like sell a little bit on top of that. So on that day, and the great part is this also, when volatile, that you're only at risk if the market really dumps. What does that mean? That means the implied volatility expands. What does that mean? Puts are more expensive, but that also means calls are more expensive, which means that you could be selling calls with a good amount of credit, and you can turn around and take that credit and do something with it. So for example, it's hard dumping on that day. What I can do is I can just go one day out further and say, okay, well, I'm okay taking some risk up here at 478, 478, 477. So maybe you can go 2 days out onto the Friday expiration here and say, okay, I'm okay taking a little risk out here on the call side. I can get 20 cents for 475, 2 days out. And what I can do is I can take that 20 cents and I can do something with my short puts over here. So what I like to do is this. I like to first look at how much delta I have in the position. So I have to put vertical on right here, and then I'm going to sell the two naked puts. That gives me a delta of positive 17.32 QQQ. So what does that mean? I want to turn this to as neutral, or maybe even a little bit negative, because my bias is to the downside. So what I could be doing is, okay, I need to get 15 additional negative deltas. I'm going to go to the call side, and I can sell 15 negative deltas. I can do 2.08s, I can do 2.06s, and then I can take that 21 cent credit, and I can then buy some put verticals on the put side. So on the put side here, I can then, 20 cents actually gets you a long way when you're that far out of the money. So you need to be adjusting this position when you're still pretty far away from your short strike, so that you can really not have to deal with a lot of delta. You can sell very low delta on the call side and buy very low delta on the put side, and just kind of sleep well at night. So for example, $20 is gonna get you $2. You can probably even do $2.50 if you really wanted to on the put side. Yeah, 23 cents. So you're getting you can get yourself that much more space to breathe on the put side. In addition, you're at, you can look at the expected move. So in the next 10 days, the market is expected to move $15, okay? And you're at 461.81. Well, 461.81 minus, just call it $16. You're going to be at 435, right? Yeah, 445. Wow, you actually have a lot more space than I thought. So even if the market moved as much as it's expecting to move, you're still not going to hit your short strike, but it tells you what the probabilities are of you getting to your short strike by that point in time, using the options marketplace as the final arbiter. So yeah, and if it keeps moving against you, just keep selling calls and keep buying those puts. If it stops moving against you, then just do nothing, because you're burning tons of theta on the call side and on the put side. Every day it goes flat is another day where you make a ton of money. So what happened? It was flat for 2 days basically, which was absolutely awesome for the position. You see that we never got challenged on the call side, selling the call spread. And so those went out to be zero. You just got 21 cents on a lot for free, absolutely free. And all the juice is coming out of the 435s or 438s or whatever you decided to move it to on the put side. And then you'll see that on this day, on the 6th, it then hard dumps again, probably another 3% down move. So let's take a look at what's going on the 6th. Maybe the 7th. Okay, here we go. So that day, we have another hard down move, down 2.68%. Okay, so let's see where the position is marked then. So you'll see that this call vertical is deep in the money. It's trading for a little bit more than $4. And, say if we moved it out to, I probably would have done it one more time. So maybe out to like 435s right here. So you're still a little bit underwater by 43 cents. Okay, what should we do here? Well, we should continue to sell calls and buy puts to kind of manage your delta. But what I would consider is the fact that I have 6 days left to expiration, basically an entire trading week. For an entire trading week, I gotta wait that long to make only $85 more per lot on the put vertical. I don't think I'm gonna be able to squeeze more juice out of this put vertical. So what I did was I sold the put vertical preemptively. Now I only sold it for $4 because I kind of just put a limit out there for $4. I was happy to get $4 for that put vertical. What that does is it gives me money in my pocket that I can use to push down the put verticals, the short puts even more if I need to. Now I was at the point in time I was still kind of just selling tons of calls and buying put verticals. Here I even found an opportunity to, on a pop, sell some calls and put a long put in front of all of my short puts. So this way I actually had a profit zone. So if the market decided to, go back and park itself at 440 or even a little bit less than 430, I would have had a ton of puts underneath that, but I had some long puts to protect my short puts. And that's one thing I always recommend, is always be protected, never be short naked. Always have one. You can have a lot of shorts, but you just put one long or a couple of longs in front of it so that there is a little bit of profit zone. And that just kind of not only gives you some ability to actually win on the trade, but also gives you some kind of mental like, okay, you just got to let the market work itself out. If you don't touch anything, let data do its job, and you might even be able to make money on this position. So that's kind of my modus operandi. So I pocketed my trade, and thankfully, the truth is this was over a 2 standard deviation move coming back from Labor Day. There was going to be at least a small bounce, and it just takes one small bounce day. In fact, I was able to put on the long put on this particular day, sell some calls that went out worthless, and then you have to sell extremely short dated calls, just 1 or 2 days out, because you are playing on your conviction that the market is most likely to go down in the short term. Not the intermediate term, the short term. And you're getting enough volatility on those calls. You don't really know what's going to happen 3 or 4 or 5 days out. When the market's crashing, it can rebound and rip your face off extremely quickly. So if you're going to short the market with short calls, keep it low delta. Keep it shorter dated and extremely low delta. And it just so happens that this particular position bounced so hard by the end of the week, what I sold for $4 was actually worth absolutely nothing. But even if the market didn't do that, even if it started going down, now on this day, I just need one update, and I can put puts in front of it. I can finance them with calls, and one update is going to just completely squish the juice out of all of my short puts. So is there risk in this position? Yes, there is risk, but they're, in my opinion, extremely easy to manage. Watch your deltas. Don't be afraid to, when you sell calls, be very selective. Don't take too much risk on selling the calls, because if you manage your short puts that are really far out and you manage them aggressively and early, you should not be taking very much heat in this trade. So on to the next. Well, Z, what's the catch? This is so great. Why don't I just keep doing this every single time? Well, I do think you should do this every single time you notice that the skew is extremely high. But the real catch, the real risk in this particular position is actually I think opportunity cost. So when you're selling two naked puts, sure, you can have a portfolio margin account and you can, it's maybe not that much nominally, but every dollar of buying power counts. You need to make sure, and that's what options trading is all about, really, is maximizing what you do with your buying power. And the truth is, when you're shorting in a bull market, it is a low probability trade. It's not every single time where the market dumps 2% on almost back-to-back days. That just doesn't happen very much. And sure, we didn't need to have that happen for this to be an extremely profitable trade, but it just doesn't happen that much. So you're giving up a lot of opportunity cost. Now, what I said was I didn't think there was very good plays on the upside from what I saw in the technicals on the daily charts, and I was okay putting on this is a relatively small position. It was only a 3 lot in my account. Normally I do 15 lots or 12 lots. So it was a relatively small position, but 3 lots is costing me $25,000 in buying power in my normal margin account. I could be doing a lot of stuff with that over the course of 2 weeks. That could be generating me like $200, $300, $400, right? Very safely if I just sold naked puts, which if I were bullish, I'd just be constantly selling naked puts, right? So yeah, that's the real risk of this trade, in my opinion, is not having that buying power on hand to put on a bullish trade or be more aggressive on the bear side. So what's beautiful about this particular position is it kind of is Warren Buffett approved, in my opinion. You don't lose money putting on a trade where you have no debit risk. So, I think he would actually approve of this options trade. I did not. Even if the market rocketed straight up, I wouldn't have lost any money with it, and I would have been completely okay. What I would have done is I would have cut the buying power. I would probably just would have closed out the trade, maybe narrowed the put vertical a little bit, and use that money to just cover my puts that I shorted. So I get my buying power back after a week and go do something else with my life. Right. Now, as a bonus, I'm going to leave you with a couple ways to not short the top. Number 1, never double down on shorting the top. If you pick the top, if the market goes 1 cent above that top, you should not be adding to the position. You should be getting out of it. You were wrong. The market is always right. If you were wrong, just get out of the position. Never, ever, ever, ever double down. Never add risk to a position that you're wrong. That's what I learned after, I've blown up my account before doing that, exactly that. Number 2, you need to manage your overnight risk. So there are times where you just gap up. So for example, if you're shorting the market and you're shorting something really hot like Nvidia, some hot tech stock, you will lose your shirt doing that. You will, not only do you, lose money, you're losing buying power as the stock increases more and more in price. You're losing buying power. So, if you can't manage that gap, if you're short into earnings and it just goes 2-3 standard deviations against you, you can't let that happen, right? You need to be able to manage overnight risk. Number 3, shorting the best stocks. Never, ever, ever short hot stocks. Irrational things are more likely to get more irrational than normal things. And I've lost so much money shorting good stocks, the best stocks or the hottest stocks or the most irrational stocks. Never, ever short the best stocks. You want to find the limping sheep that is in a weak market. You don't want to short the bull in a weak market. That's just a recipe for disaster. Number 4, everybody talks about double tops. I think it was like Jesse Livermore or somebody that says, the double tops are never the end of a trend. Never ever short double tops. Yes, you might get a little pullback. Congrats, you make a little scalp. And if that's what you're going for, sure, go for it. But never ever short double tops. And lastly, don't ever short because you listen to some perma bear on X, on YouTube, on whatever. Their objective function is getting views. And the truth is, bearish news or like stock market crash stuff just gets more views than anything else. So don't listen to them. Look at the charts. Let Mrs. Market tell you where the top is. When there's a trend change. What is a trend? A trend is when something's making higher highs and higher lows. Or on the vice versa, when something's making a lower high and a lower low. Therefore, you can short the top when the market stops making lower lows. Has the market made a lower low in the last year? The answer is no. Therefore, from here. The answer is no. Therefore, you do not short. Plain and simple. So I hope you like this information. Please like and subscribe and write a comment. Do you like this trade? Do you like my suggestions for shorting the top? And please subscribe so that you can get more content like this. I wish you the best in trading, and may the skew be with you. Okay, bye.